Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights and inspiring stories. Today, we're going to explore the fascinating world of IPOs, or initial public offerings. An IPO is when a private company decides to go public by issuing stocks to the general public for the first time. This process can be a game changer for companies looking to raise capital, increase visibility, and take their business to the next level. But before we dive into the nitty-gritty of IPOs, let's talk about why this concept is so important in the world of business and entrepreneurship. In simple terms, an IPO allows a company to tap into a vast pool of investors, providing access to capital that can be used to fuel growth, expand operations, and invest in new projects. It's like unlocking a treasure chest of funding opportunities that can help take your business from startup to scale-up. At its core, an IPO is a complex process that involves underwriting, due diligence, and regulatory compliance. Influential thinkers like Jay Ritter, a renowned expert on IPOs, have studied the phenomenon of going public and its impact on company performance. According to research, companies that go public tend to experience significant growth in revenue and employment, but also face increased scrutiny and regulatory requirements. One key principle to understand is the concept of underpricing, which refers to the phenomenon where IPOs are often priced lower than their true market value. This can lead to a first-day pop, where the stock price surges on its debut, making investors who got in early very happy. However, it also means that the company may have left some money on the table. To illustrate this concept, let's look at the example of Zoom Video Communications, which went public in 2019. The company priced its IPO at 36 per share, but the stock opened at 65 and closed at 62, resulting in a first-day pop of over 70%. This was great news for investors, but it also meant that Zoom could have potentially raised more capital if it had priced its IPO higher. Another important concept to grasp is the role of investment banks in the IPO process. These banks act as underwriters, helping companies navigate the complex process of going public and providing crucial advice on pricing, timing, and marketing. They also take on some of the risk associated with the IPO, making them a vital partner for companies looking to go public. One notable example is the story of Airbnb, which went public in 2020. The company's IPO was a huge success, with the stock price surging over 100% on its debut. This was a testament to the strength of Airbnb's brand and business model, as well as the growing demand for online marketplace platforms. Another example is the story of Spotify, which went public in 2018 using a direct listing process. This approach allowed the company to avoid the traditional IPO route and instead list its shares directly on the stock exchange. The move was seen as a bold experiment, but it ultimately paid off, with Spotify's stock price performing well in the aftermath. So, what can we learn from these examples? First, companies that go public need to have a solid growth strategy and a strong brand identity. They also need to be prepared for the increased scrutiny and regulatory requirements that come with being a public company. Finally, they need to have a clear understanding of their financials and be able to articulate their vision to investors. If you're an entrepreneur looking to take your company public, here are a few key takeaways to keep in mind. First, make sure you have a solid understanding of your financials and can articulate a clear growth strategy to investors. Second, be prepared to invest time and resources into the IPO process, which can be lengthy and complex. And finally, don't be afraid to seek out advice from experienced professionals who have navigated the IPO process before. In addition to these tips, it's also important to consider the potential risks and challenges associated with going public. For example, companies must comply with strict regulatory requirements, including filing regular financial reports with the SEC. Additionally, going public can increase a company's visibility and scrutiny, which can be challenging for management teams that are not used to being in the spotlight. To mitigate these risks, companies should invest in strong corporate governance practices, including establishing an independent board of directors and implementing robust internal controls. They should also communicate clearly with investors and stakeholders about their business strategy and financial performance. In conclusion, the IPO process is a complex but powerful tool for companies looking to raise capital and take their business to the next level. By understanding the core principles behind an IPO and learning from real-world examples, entrepreneurs and investors can make more informed decisions and achieve greater success in the world of finance. Remember, going public is not just about raising capital, it's about building a strong brand, creating a loyal customer base, and delivering long-term value to shareholders. If you have any questions or comments, please don't hesitate to reach out. And if you're interested in learning more about IPOs and the world of finance, be sure to check out our resources page for more information and insights. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.